The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're talking about money. And we're going to be talking about estate planning. Al was at a conference for a couple of days, has come back with some insights which we think are very important for you to hear. He's going to be sharing that. And later in the program, we're going to be talking about the prediction of a recession. There's a lot of confusion. What really is going on in the economy? What will happen in the next couple of years? Are we still going to be okay through 2024, no recession? Or is there? Is it possible that some parts of the economy are in recession and others are not? How do we know? That's later in the program. There's a lot to talk about today, but what is the Purchasing Managers Index? What does it tell us about manufacturing? What does it tell us about service, jobs and workers and wages? All of that coming later in the program today. But let's start. Al,
Mike,
tell us what you learned.
Oh boy, too much to condense down into our little show, but I can give you a summary overview.
Okay.
Mike, you and I have been talking about interest rates for a while.
Correct.
Interest rates affect everything. Guess what? Interest rates affect estate planning.
Of course.
There's something called the IRS code 7520, and that's the rate of interest called the 7520 rate, they call it.
Okay.
And saying, well,
what is that?
I know you're looking at me with that face. What the heck is that? And why do I care? How does that affect my clients? Well, if I set up some sort of charitable trust, or I do an installment sale to a trust for a business or an asset, what determines the rate which I pay what the installments are paid on? It's based off of the 7520 rate. Back in 1989, I think it was 12 point something percent. It dropped all the way down to 0.1% in 2021.
0.1?
0.1, which creates interesting opportunities for people to do some estate planning using certain tools. But a lot of those tools have gone away because now the rate is up at 5.6%.
Okay.
So that drives a higher interest rate. A lot of things that could be done now have to be changed. And so things that worked for the last 10 years, just like in the economy, right? Things that worked for the last 10 or 12 years and picking investments don't work as well anymore. And so you got to kind of move to a different strategy to get some of the same results.
Okay.
So that's one thing. Just basic things that change is like the annual exclusion amount, the amount you can gift was up to $17,000. They keep raising it $1,000. Pretty much $1,000 a year. So you can gift as $17,000 to as many people as you want without paying taxes, or they pay taxes, or having to file any extra paperwork to the IRS. What else do we go on here? The federal exemption, the amount that you can get out of your estate before you pay any estate taxes on, it's up to $12,920,000. How do they come up to that? I don't know.
But that 20,000 is really important.
That's really important. Don't forget that. But here's the kicker with that. If nothing is done by 2025, that's going to expire and go back down to 5.5 million. So if somebody has a large estate, their opportunity right now to get that amount of money out of their estate is, and typically the IRS won't come back and be retroactive and try to claw it back. But so that's interesting planning for someone who's got a large estate planning in the next year or so.
So the question is, do you have to die for that to be realized? Or can you gift it?
No, you can gift that.
Okay.
You could technically you could file your what's called the 709 and gift $12,920,000 to somebody, and as long as you file it, you just use your whole unified gift. So that means you can't do any more gifting without paying taxes on it.
Okay.
So that's what that means.
So how does that differ from the 17,000 you can gift?
The 17,000 you can gift as many people as want, and you can do that as much as you want. So that's different. I can give that to anybody I want. I can get that out of my estate and give 17,000 to 100 people if I want.
Okay.
So, but once I can keep doing that, but if I do one major gift that's over 17,000, then I got to file that Form 709 to say these are my gift. This is the gift tax. That's kind of the difference. It's a little more nuanced than, but that's the basic gist of it. But other things that came up, Mike, is Secure 2.0 plays a lot into what's going on right now, too. Mm-hmm. Went over a lot of Secure 2.0, and the big difference is a lot of withdrawals out of retirement plans and how it affected IRAs, which was a lot of what Secure 2.0, like, okay, here's the thing that you can do now with Secure 2.0. You can take a distribution out of your retirement plan of $1,000 withdrawal with no penalty once every 3 years. If you pay it back, you can do it more than once every 3 years if you have an emergency.
But it's limited to $1,000.
$1,000. And I don't know how much $1,000 is going to help, right?
An emergency might be going to the grocery store and spending it.
Yeah, I don't know, but I don't know where they come up with $1,000. It's like, okay, $1,000. Lifetime, you can now roll, if you have an old 529 plan, you can convert up a lifetime up to $35,000 to a Roth if the 529's been open for 15 years.
Okay.
Because a lot of people, grandparents might have started a Roth for a kid didn't end up going to school, they got this money sitting there, what do I do with it? Well, you can potentially convert it to a Roth and, pay some taxes and then move it and then do something different with it. What else can I go? Oh, so here's a big one, Mike, for RMDs. Let's say you're working for a company for 30 years. You got this huge 401k. You retire at 65, and then at 72, you have to start taking your required minimum distributions out of it. A year later, you die. Well, now your spouse can elect to be treated as the plan participant and continue just taking those RMDs if they want, if they're older, and that makes sense. That's one rule change that can, maybe benefit somebody.
Or they don't, or if they're not 72, they can continue to let it grow.
They can, I believe, I don't know if I'm correct on this, if they made changes, but if they were under 72, they could then convert it to themselves and take the RMDs and take it at a lower rate because they're younger, and then take it out longer.
Okay.
So here's where it goes. What got really fun with this, the guy talking about federal taxes, was something called reportable enlisted transaction tax avoidance. He went over case law, and this was really fascinating. I thought I'd be bored, but I was like, this is funny. So historically, when the IRS wants to make a change, they send out a notice. And they assume people just abide by their notice. Well, it came down to a case in 2019, I think it was in 2022 it started. It was Mann Construction versus the United States. This construction company had some life insurance policies that were used in part of their retirement plan as deferred compensation. Well, they didn't list it on their retirement, on their taxes. And so the IRS said, hey, this is a listed or a reportable transaction. You didn't report it. So, okay, they had to pay like a $25,000 fine. So the construction company took the IRS to court and said, okay, well, you didn't, there's something called, let me find it here, that the IRS they have to, besides giving notice, they have to follow there's a procedure they have to follow. And they didn't follow that procedure. So what the judge did in the Sixth Circuit is he threw it out and says, no, you're wrong. The IRS, you can't do it that way. You didn't follow the right procedure. They have to send out a notice of what they're doing. They have to elicit comments from people. They have to take those comments that are a certain amount of them into consideration. And when they do their preamble to reissue the ruling, they have to then use all that in their notice. And they didn't do that. So it had a ripple effect, because I'm not going to go through every single example, but that was the first one, was Mann Construction versus United States. But then there was something else what's called conservation easements, that people would buy land tracts, donate the land, get a tax deduction for that. Well, people started getting together and coming up with what's called syndicated conservation easements, where they would buy tracts of land And then they would elicit investors. And so if you gave them $100,000, you could write off up to $250,000. Well, the IRS came again and said, well, no, you're just doing this for tax avoidance. And so they issued the same type of notice. But then the one case took the one land conservation easements, whoever started these, what do they call them, real estate companies that started it, basically said, took them to court again to the IRS, and the IRS, they got it thrown out again saying, no, you didn't go through the procedures the right way. You can't just issue the notice without going the preamble and doing all the stuff they need to do. And there was probably about 7 or 8 cases that went like this back and forth where the IRS struck out on every single case. So I thought that was really fascinating. And then they went to something else, Mike, that you and I deal with. We deal with anti-money laundering and all that type of stuff. We have to kind of stay on top of these things. But there's something called FBAR. You know what FBAR is, Mike?
No.
It's not a military acronym for anything.
No.
It is foreign bank and financial accounts. So if you have more than $10,000, and maybe we have a client that has $10,000 in a foreign account, you have to list that transaction on what's called an FBAR report. And failure to do so, the fines are up as high as $10,000 per missed transaction.
Wow.
Yeah. So they went through the case of one guy, this guy, Alexandru Bittner, who was a Romanian and U.S. citizen, and he had 272 different accounts. Did not list any of the transactions, right? And he didn't know. He wasn't doing it to obfuscate, and hide his transaction. He said, I didn't know I was supposed to do this because it's such an obscure thing. But this is an interesting case. It went all the way to the Supreme Court. And I'll pick this up when we come back. It's a really interesting case.
Okay, don't go away. We'll be right back. All the way to the Supreme Court. You want to hear what happened?
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
The case, at first, when he took it to I don't know which court it was that he ended up taking it to, but they fined him $2.72 million. 10,000 for each account, 272 accounts. So he appealed it to the Supreme Court, and the Supreme Court threw it out and said, no, because he missed 5 years. So he made 5 separate FBAR reports, and only said, I only have to pay $50,000. And the Supreme Court sided with him and said, yeah, we agree with you, and he only had to pay the $50,000. But it was funny that decision that was not wasn't upon ideological lines. There were 3 conservatives that sided with him, and Kenji Jackson that sided with him too, and Barrett and the other 4 conservatives and other 2 liberals on the court sided with the first court that said, no, he owes the $2.72 million. So it was a really interesting case, thinking that, you thought it would be some along ideological lines that the conservatives might have sided with the guy with the bank accounts and the liberals siding with the first court. But no, it wasn't that way at all. So it was really interesting.
So why would a guy have 272 accounts?
He was doing international business. He filed corrected form, 61 form. He had 272 accounts.
Wow.
He had over between 3 and 16 million in all the accounts together. And he just did a lot of international business between the 2 countries and had about 270. How do you even keep track of them?
Yeah.
So it was an interesting story, though. Where do we go from there? Let's see. Well, the next section they did, I'll move forward here, this is something that pertains to us, Mike, is 21st century fiduciary investing. And they focus mostly on trust, but a lot of the stuff bleeds over into what we do. Mm-hmm. They base this off of, before the prudent man rule, before we had a lot of the modern portfolio theory, there wasn't a lot of ways to manage a trust and try to manage assets without having a sort of a map to kind of say, okay, how do we diversify? What type of assets should we? Should we be more concentrated? Should we be more diversified? Mm-hmm. And so this kind of went through. It was really interesting. 1994, Uniform Law Commission, the Uniform Prudent Investor Act. They talk about this act. Recognizing the trustee's decision should be based on process, not judgment, and by hindsight based on investment, and in hindsight based on investment performance, determining the prudence by considering the trust portfolio as a whole, rather than focus on individual permissible assets. So it goes through talking about all these, couple cases of trust. It's basically trustees not abiding by, they got to think about the ethical ramifications of taking care of the beneficiary, taking care of the trust, and doing what's in the best interest of the prudent man is making sure the trust assets are productive in the trust. That was the gist of the whole. But modern portfolio theory made that a lot easier because it had sort of the market, to call it the modern
efficient market theory.
Efficient market hypothesis, thanks. That basically said, okay, we can be sort of on this line, what they call the Markowitz line, and kind of we know what our asset mix is and how close we are to being as efficient as possible.
Well, I can remember that. Prior to 94, most trusts were invested in cash assets because they were afraid of being sued.
Yep.
And if they bought a stock, it would be called, that's not prudent because stocks can go to zero.
Right.
And so that's taking too much risk.
Yeah.
And there was a lot of concern over that because a lot of people who put money into trust needed growth out of the trust. And locking your money up in T-bills at 1% per year, you could raise the question, is that really prudent? And so all those questions came up, and finally in 1994, they allowed a change to the prudent man rule. And now trusts have stocks, and it opened the way to taking excessive risk on the other hand.
Yeah. But pensions are still, but when I think of this, when I thought of this, I'm thinking of pension funds are really, because they have a board of directors, are really stuck on this being diversified and having their hands in a bunch of different baskets because they don't want to be sued over not having non-performing assets. That's where we get conversations you and I've had about private credit. They're pushing private credit into all these different arenas and pensions and stuff like that because, okay, this is a place we can get a decent rate of return, but you're locking up the money too. You got to think about the lockup period too. And all that has to be thought through. But a lot of these plans, though, trust Mike, they go right to the big houses.
Yeah.
And they don't hire individual investment managers like us to say, okay, let's look at the whole scope of the thing. And those guys have their certain things that they like and want to do. And like, okay, this is what we're going to do. And it becomes an issue. And especially if someone dies and a trustee says, hey, wait, I should have got $2 million, not 1.2, not 1.2 million. Then these issues arise. So as I said, but the advent of modern portfolio theory did make it easier. But a lot of trusts still hold real estate. So.
And that goes back to a time when everybody knew that house prices never go down.
Yeah.
Real estate never goes down.
Right.
Of course. 2007, 2008 taught us that's not quite true.
Exactly. But it's just it's an interesting dilemma having to deal with this and looking at this from their perspective, from these attorneys' perspective, hearing them talk about it, and then thinking of it from our own perspective and saying, okay, how does this fit into what we do? Because some of this, as I said, does bleed over into what we do. But that being said, let's see, what did they talk? Oh, they talked about attorney-client privilege.
Okay.
That's you don't think of these things, right? Because you don't deal with it every day. So you're like, okay. But what constitutes, they spend a ton of time talking about what constitutes privilege, right? If you and I are having a conversation about something and we just decide, we're going to loop our attorney into the conversation, that doesn't constitute privilege.
No.
It has to be, you have to be actually approaching the attorney for legal advice, and that's maybe a little bit loose definition, but that's kind of the definition, right? Because if I just talking to them, it doesn't constitute privilege. If I want to tell them about what I want to do to commit a crime or do something and using the tax code, that doesn't constitute privilege.
And we're seeing that now with a former president and what he's going through and some of the claims of attorney-client privilege.
Yeah. Yeah.
And we've also seen in that privilege broken when there's a crime committed or an alleged crime committed.
Because it doesn't constitute privilege. And so you have to spend another whole court case deciding what constitutes privilege, right? And if you have your taxes done just because your attorney saw your taxes, that doesn't constitute privilege. So if you filed fraudulent forms, it doesn't constitute that you have privilege and those can't be exposed. Mm-hmm. So it's really fascinating. But, it just for people listening, that the sum of it was that there's numerous protections and communications among advisors between advisors and their clients to best protect those communications from discovery or produced from misinterpretation. It's important to understand the difference among those protections to ensure the communications are documented in the context of broader goals of what the client needs. So if there's taxes and all that stuff, then you got to bring it under advisement to make sure that it's all protected.
And the best way is not to try to skirt.
No, the best way is not to try, because it seems like people who try to skirt finally end up getting caught.
Yeah.
Like the conservation easements, the syndicated ones. I saw ads for those in, I think, Barron's a while back, a year or so ago, maybe 2 years ago. And they're eventually going to get caught up with them and say, no, we're going to disallow all those tax deductions. And and the question is, well, can they go back retroactively, the IRS? Well, they can. There's court precedent that they said that they can go back retroactively if you decided to, fly too close to the sun. They will go back retroactively and tax you on the last, 5, 7, 10 years, however far back they can go, and say, no, you've done this. So.
Yeah. So the best is to keep it straight up.
Keep it straight up. Pay your tax.
As bad as it, I hate to pay taxes.
We all hate to pay them, but that's what you got to do. A lot of things you got to do in life that you don't want to do, right?
Yeah, and I can remember during a tax audit one time, and the auditor, they ended up owing $6 to me.
Yeah,
and I can remember saying, I'd much rather owe a lot of taxes than owe no taxes.
Yeah.
My income is so low, I don't owe any taxes. I'd much rather have a much higher income.
Exactly.
Yeah.
The next thing they went over is interesting is post-mortem estate planning is a fascinating area. I'm not going to spend a lot of time on it, but there's a lot that's done after somebody to move an estate forward and to mitigate estate tax, to mitigate income tax. And there's a lot of mistakes people make in doing that can cause a lot of hiccups later on with the estate and beneficiaries and trustees and stuff like that. So
just to finish up that point, like how big of an estate do you need to start really dealing with an estate attorney?
I think if you have a couple $1 million, you need to figure it out, because Washington State's estate tax is at a little over $2 million per person. But you want an attorney to help you figure this stuff out.
Okay. We'll be right back. Don't go away. More to cover.
About Money with Mike Adams on AM 1300 The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
And just to finish up, if you have questions about your estate, if you have questions about what to do with your portfolio, if you're concerned about planning and making sure that your estate's passed on to your children or to the community or to someone else besides the U.S. government, contact Al. You can find him at Souza at adamsfinancialconcepts.com, or you can give him a call. Do that.
One more thing I want to mention, Mike, before we get off the estate planning, is that Washington State does have an estate tax at about a little over $2 million per person, and they started their capital gains tax last year. And so people that want to avoid the tax think, well, I'm just going to, before I die, move to another state. It's a lot more complicated than that in Washington State. You can't just pick up residency and move one day. It's actually what they look at is where you're domiciled. right? So if you just pick up and try to go to Idaho and die the next day, if you still have your car here registered, you still vote here, all that stuff, so they'll come back and try to claw back the taxes from you. So it's not as simple as picking up the day before you decide to croak.
So Jeff Bezos is moving?
Yeah, he's doing it in plenty of time. He did a big public announcement, so he's going to be fine.
So, question is, what's going on in the economy? There's a number that I want to talk about, the Purchasing Managers Index. I think it makes a lot of sense to follow the Purchasing Managers Index and understand what it really means. And there's two indexes, one for manufacturing, one for services. When you're a manufacturer or a service company, when a manufacturer is easier to see because you might have to order raw materials. You think you're gearing up to produce more. You've got higher demand. You're going to make more widgets, more shoes, more clothes, more aluminum ingots, whatever it is. The first place you go is you go to the purchasing people to say, we're going to gear up and we're going to produce this amount of product. And so the purchasing manager is usually the first person that sees the actual orders going through. There's a lag time between the time that things are purchased and the times that they're produced and sold. And so the Purchasing Managers Index gives you a very good indication of what's going on in the economy. And if that index is over 50%, it's an expanding economy. If it's under 50%, it's an economy that's in contraction because you're ordering less than average. Over 50% means you're ordering more than the average. So the reason I bring it up is if you look at what's gone on in 2023, you see that the Purchasing Managers Index for manufacturing has been negative for almost the entire year. It's been negative, indicating that for much of manufacturing, there is a recession going on. On the other hand, if you look at the services, the Service Purchasing Managers Index is significantly above 50%. You know, if the index is 50.5 or 51, that's still an expanding economy. It doesn't have to be much above 50. If it's at 49, that's a recessionary indication. And there's things that affect it beyond that, but it's a really good rule of thumb indication as to what's going on. And as we live in this period of time, we've been talking about the number of jobs that are going unfilled. You know, 8 months ago, there were 4 million jobs more than there were workers to fill those jobs. But almost all of those jobs were on one side of the economy, on the service side. And if you look back at what's going on, the manufacturing side has decreased as a total percentage, and it's been the service side that's been growing. And so what we're looking at today is the service side, which is really supporting the economy and making it go. Well, manufacturing is struggling to some extent. Not every portion of the manufacturing, but part of manufacturing is struggling in the economy. And you can think of some service things that are struggling too. You know, refinancing has dropped off a cliff. Interest rates went up. When interest rates were going down, people were refinancing their house. I think you had the numbers out that prior
refinancing? I don't have them right in front of me, but
it used to be that a significant portion of mortgages were floating.
Yeah, and I forget the number, but it's a huge number of fixed now.
Yeah, and at a low rate. And
so less than 3%, 3% or better.
Yeah. So, I mean, what's going on is, you know, people are not doing the refinancing. And you can think of a lot of industries where interest rates being higher have slowed down the industry. Most recent ones we talk about is the individual solar panels, which have slowed down, and solar energy slowing down. Hasn't slowed down the big utility type solar installations, but certainly individuals have slowed down what they're doing. If you look at a lot of the industries, it's a really pick and choose kind of economy. In total, the economy continues to expand, but individually, looking at each portion of the economy, some are expanding and some are contracting. And the chances are that kind of thing is going to continue to go on through 2024 and maybe 2025 and maybe even beyond that. So it really becomes picking and choosing where you want to invest your money. There's another thing that comes down, and I talk about it in terms of manufacturing, but it's a much larger thing than that, and that's the wages that are going on. Not too long ago, we went through the auto workers strike. Remember what happened back in 2008 when General Motors and Ford were on the verge of bankruptcy? It was the United States government that bailed them out. And part of that deal was that the workers, new workers that went to work for General Motors or Ford, were going to go at lower rates than existing workers. And they were going to give up their COLA, the inflation. And that in 2008, that didn't seem like a big deal.
All the way to 2021, it didn't make a difference.
But in 2022 and 2023, it's a very big difference.
It's a huge difference, yeah.
And the workers took decreases in their pay to keep the jobs and keep the companies going. So here we get to 2023, inflation is going, and there's a shortage of workers. And so what happens is we have a strike. And they got back a lot of what they lost. They got back their COLA. They got back a significant wage increase. The new workers get started at the same salary or same wage rate as the older workers. So, I mean, all of that went together. And if you really go back and look at what's gone on with wages, there's a website that's called WTF Happened in 1971. You know what the WTF stands for, anyway?
No.
Anyway. There was a fundamental shift in the economy in the 1970s. Wages through the 1960s were rising steadily, but they flatlined in real terms after 1973. From 1947 to 1973, all the income levels were rising at the same rate. In 1973, the top 5%, after 1973, the top 5% continued to increase, but the bottom 95% flatlined. It resulted in the fact that the top 1% made the 25% of all income. If evenly distributed, the top 1% would make 1%. But in 1919, I'll get to the right century. In 2022, the top 1% were making 25% of all income. And yet, if you look at productivity per capita from 1948 to 1948 to 2017, productivity increased 248%. But during that period of time, wages stagnated. GDP per capita increased 325%. Wages stagnated. So part of what we're seeing today is a catch-up on the lower 95%, and especially in the lower 50%. And we've seen during that same period of time, not only has the income disparity increased, but budget deficits soared, trade balances soared, and savings rates tumbled. You know, we talk about how we look at changes in technology, demographics, and lifestyles. Mm-hmm. If you look at the number of 25 to 29-year-olds that are still living with their parents, since 73, it's tripled. If you look at the median marriage age, in 1973, it was 21 for females and 23 for males. Now it's 28 for females and 30 for males. And if you look at the number of children born to unmarried women, that too has skyrocketed. If you look at childhood obesity, it's quadrupled to over 20%. Health expenditures increased 15 to 20-fold. And I bring that up because when Obamacare was passed, those increases slowed down significantly. Today, they're picking back up. All that's going to affect.
Why is that? Do they give an idea why that's picking back up? Because Obamacare hasn't gone away. I mean, it's still.
No. Obamacare pushed the bubble down for a while.
Yeah.
But you can push the bubble down one place.
Yeah.
It's starting to come up another place.
Mm-hmm.
It's something that nobody really talks about. But I can remember prior to Obamacare, a lot of people talked about taxes and the taxes businesses had to pay.
Mm-hmm.
But the biggest concern was not taxes. It was healthcare.
Healthcare.
Healthcare increases were rising at 9 to 12% per year.
Mm-hmm.
We're back to 6 to 9% again, rising much faster than GDP. Don't go away. We'll come back and talk about this whole thing. I want to talk about the front page of a Barron's article that happened 10 years ago and the predictions. Don't go away.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So coming back, I was talking in the last segment about the wages and how wages for the lower 95% have kind of stagnated and flatlined and how that's catching up. William Nordhaus got the Nobel Prize. He was an economist that said what happened in that oil crisis of 1972 to 1973 was that two-thirds of industries were oil intensive. Think about the food that went to the stores. They went in trucks. When oil prices went up and gasoline prices went up, that increased the price of food. That has made a significant change, and that's now beginning to change as well. And that brings me to this article from the front page of Barron's 10 years ago this month, 2013. It was a featured article, and it said the U.S. economy is slowing down. I didn't believe it was slowing down in 2013, and I said that on the radio at that time. But the article was about Robert Gordon out of Northwestern University, who I called the new Malthus. Gordon said that there were 3 cycles, and I've talked about the super cycle, but he talked about 3 different cycles. He said the first cycle was from 1750 to 1830. It was driven by the steam engine, cotton spinning, and the railroads. The second super cycle was from 1870 to 1900, driven by electricity, the internal combustion engine, and running water being the most important of the 3, according to Gordon. The third cycle, he said, was from 1960 to 1990s, driven by the computer. But since the late 1990s, Gordon says innovation has slowed down. He said in 2013, we're entering the time of slow innovation, slow productivity, slow growth. Wage growth has slowed down, and it's going to continue to get worse. And he was all over the news, not just in Barron's, but in the Wall Street Journal. And time and again, you would have articles about what Robert Gordon had to say. Now, if you would have asked Robert Gordon back in those days if he thought in 2023 or 2020 or 2015 or 2018 that if he was going to fly into a different city, either for business or pleasure, get into a stranger's car who would drive him to a stranger's house where he would stay, Robert Gordon probably would have laughed about that and thought, you were kind of crazy.
It's kind of funny, Mike, because it reminds me, I just finished the book on FTX.
2 biggest taxi companies in the world?
Yeah.
Lyft do not own a single taxi?
Yeah.
Largest hotel chain in the world did not own a single hotel chain? Largest media company owns no media, and that's Facebook. Things have not slowed down. Things continue to grow at perhaps an even faster rate.
No, I was just saying to you, Mike, I just finished the book on FTX that Michael Lewis wrote.
Yeah.
And so it prompted me to go back and watch all the commercials that FTX had at the Super Bowl. And I love the one with Larry David where he goes through time. He's sitting back in, ancient times, and some lady comes up to him with a wheel, and he says, "What do you think?" And he's, "Eh." and then he's in medieval times, and some guy comes up to him with hey, look at this new way to eat. It's a fork. And Larry gives, what? I got 10 of them right here. Holds his hands up in the air. And it keeps going through time like that till he gets to, FTX. And the guy goes, what do you think? And he says, but innovation keeps happening and we keep getting more and more productive.
It's faster and faster.
Exactly.
But I use Malthus for a good reason.
Yeah.
Because Thomas Malthus was an economist that lived, English scholar, 1766 to 1834. And he was an economist that studied economics and the population. And he believed improvements in agricultural productivity could go no further. They were done. And the result was there was going to be a limit of food. When the population grew faster than the food supply, wages were going to sink. When you had famines and epidemics and wars to reduce the population growth, according to Malthus, that was really good because you're reducing the population. He recommended that people should be celibate and married much later in life. He argued against the poor laws. Not long after he died, in the 1850s, if you look at U.S. farm productivity, 50% of the U.S. population was employed on the farms. We had 23 million people, and 11 million of those 23 million worked on the farms. Today, if you look at the population of the people that are working on the farms, we have a population of 330 million. Less than 1 million people work on the farms. Today, we're producing almost 1,000 times what we produced in 1850 with a labor force of less than 10%. In 1850, there were no tractors.
No, what was the government in the 70s and 80s was producing, paying farmers not to produce, right?
Yeah.
Too much production.
Too much production. No combines, no pickup trucks, no, all of that. But when you're in the 1800s, 1834 when he died, the early 1800s, when you're looking at productivity and what's going on, and you're looking at all the arable or cultivated land and no productivity and people still using the plow towed by the pulled by the horse or the ox.
Yeah.
It's hard to see that same piece of land and that same farmer is going to produce 1,000 times what he was producing in 1830. The same is true today. When you look at where we are today, we think of forecasting what we're doing today in a straight line. We think of how we travel to be the same way we traveled in 30 years or 40 years. I like to use the picture sometimes of the Native American in the 1500s standing on a hill in Oklahoma looking around and seeing the buffalo. Do you think that person could ever imagine the highways, the buildings, the planes flying overhead, the railroads, the cars, the transportation? No. I mean, we live at a time in which technology is not slowing down.
Like you and I both like the movie Shawshank Redemption.
Shawshank.
Remember when the first guy, what's his name? They make the library after him, gets released from prison.
Yeah.
What's his name? I can't think of his name.
See, we're getting old.
Again, I know. But he gets out and he gets trying to race through the cars. He says the world just went and got himself in a big hurry.
Yeah. So the world is changing. It's going to continue to change.
Well, with the advent of quantum computing, right, we'll be able to do millions of calculations in seconds. AI, quantum computing, all these things are just going to be...
And bioengineering.
Yeah.
We're just at the beginning of a lot of these
infancy
things.
stages.
So
Look at the gene editing where you can take something out of the genetic code and replace it and stop some sort of really, awful genetic diseases.
yeah.
And that's we're at the infancy. We haven't even scratched the surface on this stuff yet.
And all of that is in biotechnology, biohealth. Bioengineering is going to stretch far beyond.
Look, there was a drug
biohealth.
just released, right? That was for diabetes. Now they're saying, now it's works unbelievable. We can use it for weight loss. You mentioned all those kids that are obese.
Yeah. So anyway, all of that to say, there's so much going on. We live in a time which is very different, And you can't look back just in history and try to extrapolate history into the future. You have to be aware and visionary of what's going on, what the changes are, and where we're headed. That's the whole point of this whole thing. You can't say just because the Fed raised interest rates in previous times that it resulted in a recession. It has in certain industries, but not in others. You have to look at what the situation is, and there, find the correct investments. And with that, join us next Saturday when we'll be back to talk about money.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.